Thank you for joining us today. My name is Michael Wales and we are the RPA Group. I'm here joined with my colleagues Joshua Phelps and Elliot Rowe. And you've joined us today for our UK property investment webinar. I'm here to talk about the answers to all your questions. Now, this is an in-depth Q&A in response to a lot of commonly asked questions that we have from our clients and also potential investors. So what we've done over the last couple of weeks is we've actually spoken to potential clients and also people that have already invested with us and asked them, what were their thoughts during that process before they even spoke to us, and how did we kind of combat the questions that they had. And also, like I said, we'll have a bit of a Q&A at the end as well. So any questions that you do have today, please feel free to add to the chat section, and we'll answer them at the end of the presentation. So just a quick brief on who we are. So I know a majority of you may know of us already, but for those that don't, we are the RPA Group and we're headquartered in the UAE. The management behind the business has been in the investment property industry for over 2 decades. And myself, Elliot and Josh have also been in the market for over a decade. So we're bringing a wealth of experience to the business. And we are offering a diverse portfolio across the UK currently. And in the past, we've looked at areas like Germany, Portugal, Australia, even the United States. But right now, we're currently focusing heavily on the UK. And also, we are going to potentially have some projects coming up in Germany like we have done in the past before. So as you can see, we're based headquartered here in the UK, which is where me, Josh and Elliot are. We do have offices in South Africa, Hong Kong, and also the UK for any of you that are joining us from those locations. So moving right on to the first couple of questions we have here. The first question we have for the audience is now the right time to buy in the UK? Elliot, do you want to take that?
I will take that, just unmuting. Thank you very much. So hi, everyone, and sort of thank you for joining. So just in terms of, everything that's going on with the UK, when we're sort of reading the papers and actually from a world perspective on inflation and everything like that, it's quite often with the media, and if you read what you will, especially for all of us that are sort of overseas and looking back at the UK and looking at sort of micro media comments or snippets and particular things that are going on, it can sort of send a few warning signs. I think it's probably the best way to describe it. And actually, if you look at it sort of say in a blinkered view, you may not actually see the bigger picture and actually what we're looking at when we're thinking about the UK. The very quick short answer when anyone asks me this question, is now the right time to buy? I sort of slightly flip it around really and say, if you have the money to invest now, any time is as good to invest. So as long as you have the money to invest, now is the right time for you personally. There's obviously a personal element to all of this. And the reason I say that, not to be flippant, but also because when we're looking at the UK, the first thing that I mention and we talk about when we're looking at this sort of investment and the timeframes that you're looking at this investment is it's a 10 to 15 year minimum sort of hold. And the reason I say that is because historically, and we're looking back at statistics, that the UK house prices double every 10 to 15 years. So if you, on a sort of a much more shorter spectrum, if you hold a property for a minimum of 5 years, then you will definitely see a significant return in sort of the capital appreciation on that particular property. So if you're keeping it for that 10 to 15 years, we see you're going to really sort of get that sort of maximum growth from the properties. Now, so that's the first thing to consider. So when we're looking at this historically, and another thing when we're looking at particularly real estate and in the UK, we've only, so in the last 56 years there have only been 7. So in 56 years there've been 7 years where the property market in the UK has dropped, has grown negative. There's been a negative growth, and for out of those 7, 5 of those years are in negative or in single figure growth, negative growth. So when I say negative, I'm talking about 1%, 2%, 3.5%, and that's 7 years over 56 years. So as you can imagine, that's such a great time frame to look at and analyze why something is a good time. It is a solid independent market. So that's what I really look at. So when I'm thinking about is the time right now? First of all, is it right for you? Do you have the money and are you able to invest? And secondly, let's look at this historically, and it's always the right time as long as you're able to. Particularly, this is a bit more centered particularly to UAE buyers, and a big advantage at the moment as well is the pound is still relatively weak when we're for a dollar pegged currency, and so we're still seeing significant savings really in comparison to sort of the last 10 years in terms of buying that UK property. So overall, look at the big picture, and then we have a little micro thing looking at, say, the currency play at the moment, making it as good a time as possible. So that's I hope a sort of a snapshot of what I think of why it's now is the right time.
Yeah, good. So you're kind of saying, I guess, a snapshot would be that buying now is because the market's always moving, and the majority of the time the market has always moved up. So actually, if you don't do it today, then the market is moving forward, and so ultimately going to cost you a bit more money the longer you wait.
Yeah, exactly. Yeah, we're other than 7 years over the last 56, we've seen positive growth. So I think, and that says it all, really, doesn't it?
Well, I think that brings us nicely into question number 2, which is, I think, is something that we all get asked quite often. Should I buy an investment property in the UK or Dubai? Obviously, we're based in Dubai, and we've seen some tremendous growth here, certainly in the last 18 months from a property perspective. And ultimately, they're two very different investments. We're looking at the UK, which you've just spoken about, Elliot. Having that historical, mature growth. Adding on to that as a kind of a solid legal and financial structure that we have in place, and have done for hundreds of years in the UK, which we don't have in Dubai. And yes, obviously, we're based in Dubai, so we watch what happens in the market here. And when you're looking at what is happening within the market, it's interesting that there are certainly locations in Dubai that have gone crazy price-wise, and people have seen tremendous growth over the last few years. There are other areas within the city that aren't doing that. In such a small city, there's just a few pockets there that are seeing all of this growth over that period of time. Now, when I talk about the two very different investments, they are, because in Dubai, people are what we call kind of chasing the yield. What you'll find is there'll be high yielding opportunities that will kind of suffer on that capital appreciation aspect. And when we're looking at the projects that we launch in the UK, they're very much a combination of both. So we're always looking for those city centre locations, or locations where they're going to have this a nice steady growth of capital appreciation, and also providing a good sound yield investment as well. And something I always say to my investors and anyone that I'm speaking with about a property is that look at yield as risk. So if someone's offering you something that's going to give you a 15% guaranteed yield over the next couple of years, that's definitely going to be a risky investment. What's going to happen after that period of time, and why are they offering you such a high yield over that short period of time? So there's a lot more in depth there, but ultimately, when you're looking at having something that's going to be a safe, secure, and pretty much the lowest risk property investment in the UK, you could argue. In the world, you could argue the UK is certainly that. I mean, do you guys have anything to add to that at all?
Yeah, I think what's interesting is that, as you've said, the UK is such kind of a market that grows consistently over time. Of course, we've got the odd 7 years in the past 56 where it's not been the case. But I would say that's more, it's kind of long-term investing is exactly what it is. Whereas Dubai is more day trading. It's a much more immature market and much more volatile. I mean, I'm sure we all know people and have got clients who have done very well here, but you have to be ready to get in and get out the market kind of in a heartbeat, because it can, of course, it can go up very quickly, but then it can also go down quite quickly. So long term, Dubai makes a lot of, UK makes a lot of sense, but then there is still, yeah, absolutely, there's money to be made out here in Dubai, but you just have to be on the beat. It's much more an opportunity you have to take at that time, as opposed to, right, let's think about some long-term investments.
Yeah, and I think what was also interesting, just looking at the kind of stats, you know, we're nearly at 70 million people in the UK now. You know, I think the latest was around 67, 68 million. So probably today it's probably at around 70 million, and over 60% of those people own property. And that's great, but what that means is there's nearly 40% of people that are going to be renting property in the UK. So there's a massive rental demand in the UK, and ultimately we just can't build enough properties quick enough to cover that demand. So moving on to question number 3, what should I look for in a location? Now we've got a map there of the UK. There's obviously lots of cities, towns, you know, counties as we call them, areas, Scotland, etc. You know, do you want to, Josh? Do you want to take that?
Yeah, absolutely. Yeah, it's a good question. I think it's important because a lot of people will see an attractive growth projection of a city, and then without taking into consideration that this projection is an average for the city, meaning there'll be some locations within the city that perform under that projection and some that overperform it. So what we need to look at is the city on a kind of not just a macro basis, but a micro basis. So where within the city is the development that you're looking at? What's going on in that area? Is there significant new transport links? Is there even a solid transport network within this area? I mean, ideally linking to a large job node or an area where tenants would need to commute, like a university campus, something like that. Population demographic shifts need to be taken into account. Is there a new corporate hub nearby, like Paradise Circus in Birmingham? Regeneration, huge one to look at. I mean, it's a word that it gets kind of thrown around a lot, but for good reason, because it can be the single most important factor as to why an investment will just do okay, or the reason why it could drastically kind of outperform the surrounding areas. I mean, in a nutshell, it typically presents an opportunity to invest in an area before there's a chunky growth hike. Historic price data shows that there are significant, when there's significant regeneration, there's always a hike in kind of capital appreciation. I think it was CBRE that did the study on this and the regen effect, and it was an average price hike of kind of 3.5% annually. So it's not something to be overlooked. And it's all these kind of growth indicators that need to be taken into account when you're looking at an investment property. When you combine the data and actually spend some time doing your due diligence, it can be quite clear where there's significant opportunity within the city. So I think you just have to be a bit more diligent at the moment and think, where within the city is the development? Why is that area going to outperform other areas? And then just looking kind of the obvious stuff like pricing, stuff like that, to make sure you're actually buying into kind of something that's fairly priced for that area, and we'll see significant growth. But yeah, there's a lot of things that need to be taken into account. It can't just be, oh, Birmingham's going to do well, I'm going to invest in Birmingham, Manchester, Leeds, London. You have to do a bit more due diligence and look into why the specific area on a kind of micro level within the city. So yeah, I think pretty much explains that one.
Yeah, and I think you know, obviously that's why we're here, right? That you know we do a lot of that ourselves before even you know working with a developer or even you know bringing a project to the market. And you know, me personally, that I kind of look at these kind of 4 pillars, and I know we do as a business as well. You know, you're looking at, you mentioned you know, transportation. Is it close to a good transport link? Education, is it near a university? You know, regeneration, as you mentioned, is it within a regeneration area? And also the big one is down the supply, which I've already mentioned earlier. But you know, those 4 key things when you're looking at a project, you know, if you can hit 3 or 4 out of 4, then you know that's going to be a pretty good investment and something definitely worth looking into. But
yeah, I couldn't agree more.
For anyone on the webinar today that's looking at this and you get offered a project and someone just, oh yes, just regeneration, and there's 3 other ones missing, start considering something else. Look at other projects where it really hit those kind of 3 or 4 of those key things. So moving on to question number 4, should I buy a 1-bed or 2-bedroom apartment, and which will give me the best return? Elliot, you want to take this one?
I will have a stab at this one. Sure. Okay, so what we would generally say, and again, sort of putting the question back to the client, in many ways it is, or to you, the buyer, is what can you afford? How much do you want to invest in this particular property, in this particular scheme? So that's sort of the initial point, because, and the reason why we say I would ask that question is that generally, and this is a generalization, but generally speaking, we should start to see good returns on both the 1 and 2 beds, and even sometimes the 3 beds. Now, the reason for that is because if we go right back to where we started, whenever we take on a scheme, whenever we look at a project, whenever we've spoken to the developer right from the outset, when they're going through planning and they're right the infancy of the whole project, is we're looking into the analytics of the area, we're looking into where the demand is, we're advising the developer to put in particular numbers of units, because we've done the analysis beforehand to see where the tenant demand and everything is. So with all the schemes, they are well thought out. They're not just putting, a tower of buildings up and this and just deciding, okay, we'll have 10 1-beds and 15 2-beds. There's a lot more analysis, a lot more theory that goes into it right from the outset to when we bring it to market, to ensure that what we're doing is we're getting the best return we can for our investors. Now, so that's the initial stage. But then if we sort of drill down a little bit further, from a personal opinion, I like the idea of 2 beds flexibility, because depending on where you are and which particular project and that side of things, you're able to add that as I say, that sort of extra bit of flexibility, because a tenant could either be one person and he wants to have a spare room, one person who wants to have an office rather than working in their sitting room. It could be a couple with a small child. It could be 2 groups sharing, and so on and so on. So you see where I'm going. It offers that flexibility. Whereas with a 1-bed, actually, there isn't as much flexibility, but obviously your investment is less. So that's the sort of a personal view. Now, when I then look at statistics, though, and obviously we bear in mind what we've seen over the last 3 years of all our lives with COVID and everything that's happened there, what we've actually seen is the flip side of what I've just personally think. Whereas we're seeing 1-beds have actually outperformed and got up in terms of, in a comparison performance, they're 4% better than they were 3 years ago. And 2-beds, though, are down sort of circa 15 to 20% in terms of performance from a rental perspective. So what we've seen is, and I think this is much more of a relic of COVID and people wanting to, they live on their own or live with a partner rather than sharing with friends, or having that extra bit of space, or wanting to, or maybe even being able to afford that extra bit of space. So that's basically what we've seen in more recent times. So the short answer is, set out what you feel you want to invest, and then we look into the detail, because the 1 and the 2 beds should be giving the returns, and then we could look into a few more specifics as to what. But if we were going to say it today and it was straight up, no idea, I want an answer, stop asking me questions. I want an answer. The best performers are 1-beds as it stands today, compared to 2-beds.
Yeah.
Does that answer the question?
Yeah, kind of. But yeah, I think, but from that, what you're saying, I guess, obviously, then, as things are changing and the world has changed dramatically over the last 18 months, 2 years with COVID, and then Omicron variant and everything else that went on in the UK, is that there's potentially an opportunity here for 2 bedrooms in the future to become more desirable, with space opening up and people more willing to interact with each other. And also potentially, like you mentioned there as well, you know, a professional having a 2-bedroom apartment instead of a 1-bedroom, and then using that as their office and going into the office if they change it to a 2 or 3 day working week. So yeah, like fantastic. I think it's I think there is an opportunity for 2 bedrooms, but as you said, the statistics day one at the moment, 1 bedrooms are looking more favorable. So moving on to question number 5, should I buy a house or an apartment? And I think this is something that does come up quite regularly. You know, we have investors, well, look, we all grew up, well, the majority of people would have grown up in a house. So we're quite, you know, that's what we feel comfortable with. And I think that's where people do look at themselves investing into a house in their home country or into a country as an investment. But you know, what would the difference be, and why should they consider an apartment over a house? Josh, you taking this one, or Elliot, you want to take this one as well?
Yeah, I'll believe this one. I'm happy to answer this one. So in short, from a management perspective, when we're looking at apartments or houses, and a lot of people, obviously a lot of our clients are based overseas, it's far easier to manage an apartment. It's far easier from your own personal perspective, to sort of, there's less things that can go wrong, and easier from a management perspective to ensure sort of from a maintenance and everything else like that. Now, the reason I say that is when you purchase a house, you'll obviously be purchasing the plot of land it sits on, the freehold, so, and everything that encompasses that. So that's the gardens, the roof, the doors, the windows, gates, and everything that you would imagine sort of a typical house to have. Whereas when you purchase an apartment, typically they are leasehold. 99% of the time, you might get share of freehold, but typically, let's say, they are leasehold. Now, what this really means is you own the footprint of the apartment and everything on the internally of that apartment. That is your that is your responsibility. That is your ownership. But when you're in say a block of apartments, or even a block of apartments or a converted property, whatever that might be, anything external, also communal areas, gardens, rooms, windows, everything are managed and maintained by the freeholder. So a third party will cover all those maintenance costs, will cover the building insurance and everything like that, and you pay a service charge for that. But it just means that the entrance hall will always be clean and tidy. It always means that the gardens will always be maintained, and all the sort of the smaller things, which from a day-to-day perspective you may not think about, but actually are really quite important when you're, effectively having to market your asset. You're having to make your asset look as attractive as possible to achieve the best rent, and so doing that with a house has more management difficulties. There's more to go wrong with a house than there is with an apartment. So if you're looking at this purely from an investment perspective, I would always say you should go for an apartment. Obviously, if you're thinking of having a property in the UK as a sort of a holiday home or something you may use as well, then obviously, that the house element kicks in, and that becomes much more of a personal decision. And you may want it, by using it yourself and things like that, you want it to be yours, and so you're willing to take some of the maintenance factors and risks out of it, really. And finally, if you look at Mike sort of touched on this earlier, so the UK has a chronic undersupply of property. Okay, so it's 300,000 properties a year that need to be built, 130 odd or something that was built last year, 130,000 that were built last year. Typically, because the UK is very old and is incredibly established, typically a lot of housing in city areas is sort of based roughly around Victoria. When we saw Victoria in the Victorian age, we saw the industrial age, we saw everything boom in the UK. So there will be lots of terraced Victorian houses, streets, and things like that. Now, lots of those are listed or protected or still maintained, and people love living there, and that's fantastic. So there is a number of houses and things in particular areas, but what there isn't is apartments in those certain areas in city centre locations, which we're looking for, because you can walk to work and all those sort of things, what a tenant may want, but they don't want to live in a house, they want to live in an apartment they can lock up and leave. And so therefore there is, from city centre locations, that there is a bit more of an argument from a scarcity perspective, and therefore a bit more demand to typical locations, like we have one down in Brighton, for instance. There hasn't been a new build apartment block built within 2-mile radius of it within the last 10 years. So therefore you're building that, you're offering something that isn't currently available, and increasing the interest to that particular investment. And ultimately, if you're buying this as an investment, that's what you want to do. Okay.
Yeah, just excuse the pun, but it kind of hit home with me last year with my house that I have that's rented in the UK, and they had a big storm in the winter, and the fence blew down. So then I had to then get someone to make sure they've got a child in the house, they've got a dog as well, so we had to get someone to emergency go up there, fix the fence. That was over a couple of £1,000 to get that repaired, which you're not going to have that factor come into play when you have an apartment, and that's over £2,000 coming off of my yield, off of my investment. There's a cost that I didn't expect or didn't even think of, and so that's definitely something, like you mentioned already, it's definitely something to be aware of, that there are additional costs that will arise when buying a house rather than an apartment. So yeah, that's great.
Just
question.
Sorry, Michael, just to add to that, I was just going to say, typically when you're looking at an investment property, you're going to have a higher yield with a smaller unit, like a 1-bed or a 2-bed. If you get 3-bed, 4-bed houses, stuff like that, your yield's going to be often and typically significantly lower as well. So if you're looking for like passive income, if you just retired and you wanted a passive income producing asset, perhaps house wouldn't be the one to go for, because kind of the yield's going to be lower. So you want to go for something like 1 or 2 beds, kind of thing that we've discussed before. Just something to take into account as well.
Yeah, no, good point. Really good point. Then moving on to question number 6: how do I manage my property when overseas? Josh,
okay. Yeah, it's important. So the majority of our clients live around the world. We've got clients here in the Middle East, we've got clients in the Far East, Africa, parts of Europe. We've got some in the UK, but typically they're overseas. So what's important is having a reliable property management company. I have had a handful of clients in the past tell me how disappointed they've been with the service they've received, just because they've had to get far more involved than they'd like to, or they haven't had the reports on time, stuff like that. Because you have to, of course, have the reports going to your accountant or however you're managing the property, to make sure that you're paying tax and all these kind of things. So unless it's done properly, and also the tenants need to be happy. If the tenants aren't happy, you're not going to have a good investment. And it's just going to be a whirlwind of problems. So for that reason, we've got a letting and management company within the UK called Brick Management and Lettings, and it's full management service. So this is marketing the property before it comes to completion, assuming you're buying off plan, before you come to completion. So what this does, of course, it generates interest and minimizes vacancy. And then they'll do everything on behalf of the owner. So take practical handover, so they'll take the keys, they can inspect the property and complete any snagging work that may need to be done, if any. At that point, they'll start kind of vetting the tenants and sending offers on rental offers to the landlords or owners to approve. After this, they can actually hand over the apartments to the tenants and then oversee the ongoing management of the property. Because as an investor, as a landlord, you don't want to be having a call saying, "Oh, the intercom's not working" or anything like this. You need someone that's going to be the first point, or a company that's going to be the first point of contact with the tenant. So if anything goes wrong, I don't know, there's a boiler leak, whatever it may be, they're there. And it's super important and can be overlooked. It was last year, I sold a few units in Birmingham, and they ended up, the investor went with a different management company, and then after about 6 months gave me a call and said, look, we want to sign up with Brick. It was slightly cheaper, the other one, but you kind of, as with everything, you get what you pay for, and it was just a very cheap, poorly managed service, and it ended up being a nightmare. So again, having a fully managed service just makes so much more sense. And then again, end of the year, they can kind of renew the contracts with the tenants. Also, another thing to mention is they'll arrange all the insurances as well. So you have to be covered as a landlord for certain things. And you want all this just covered for you. You want someone to just take care of all of it. So super important, but you can have a fully hands-off service. I mean, some people think they would have to fly to the UK to sign stuff, take the keys and that kind of thing, which just isn't the case, which is great. And they've got a very, very, very low churn rate as well. So it's just a good service. It's exactly what you need. And Brick only do short, long-term AST tenancies, so kind of an annual tenancy. However, we do offer some properties on short-term basis, which is a slightly different and more complex service, but we have got a partner company that we can use for that, and we've had no complaints about them at all. They've been fantastic. Actually one of the best ones that we've vetted. But yeah, that's pretty much it. It is important to have good management, and I think a lot of people overlook it and think that it's not an important aspect of property ownership when it really is. Yeah, I think that pretty much covers it.
Yeah, I think, I'd agree. And I think it's one of those things where people think that just finding that right location or finding that right company to work with, like ourselves, is the investment. Well, actually, that's probably, only less than 50% of it, right? Because then you have to have that. And if you hold the investment for 10 years, but you don't have the right management company in place, then that's where you get the return on your investment, right? We're going to find these locations that are going to grow in capital appreciation over that mid to long-term period of time. But, having someone that's professional and going to source the right tenant for you, going to actively manage that for you is important. And look, we all know in every industry, in every walk of life, you can always find someone who's going to do something cheaper. But, the old analogy of buy cheap, buy twice certainly is a major factor, especially when you're looking to manage a property, because if they don't do it properly, that can really affect you over the short term and the long term. So yeah, and
I couldn't agree more.
Have been fantastic since we've been working with them, and I think they manage over 600 properties now so far in the UK and growing year on year. So fantastic.
Yeah, and it's also important because they release reports as well showing current trends. They'll make sure that your properties are getting the best amount they can. So you want to. Some management services will go, oh yeah, it was on for 1,100 last year, let's put it back on. Whereas Brick would actually look at the trends in the local area and find out, get you the best price year on year. It may only be £50 a month different or £75 a month, but as that compounds, it makes a big difference over your investment journey. And they also look into data when you're first getting the property. So if it makes sense to have it furnished or not, because they might have huge demand in the area for properties which are furnished, because I don't know, like for example, Birmingham, they've got Goldman Sachs moving there, PwC, Deutsche Bank. So they're looking for these kind of top tier corporate tenants that want a beautifully furnished apartment, and they're just going quickly. So that in that point, we'll say, yep, let's get it furnished and get people in. Or they might say, actually, there's a real trend of people that just want unfurnished at the moment. So in which case, you won't get it furnished. But it's nice that they're far more on the ball and kind of data driven than a lot of other companies, which ultimately helps you out a lot. I
agree. So moving on to question number 7, should I buy in my own name or a company structure? I think with this one, again, it's becoming more and more of a common question for us. And it's not as simple as, it's like the 1-bed, 2-bedroom question. It's not as simple as one is better than the other. It really does come down to how you're looking to use that investment over, what term you're looking to use the investment, and ultimately what you're trying to achieve from it. And, as a business ourselves, we don't look after that whole process of putting the property into a company structure. And there's a very good company that we do work and partner with, which I'll mention. But just to kind of come up with a few of the key reasons why people are looking at this. So, and debunk a couple of questions that people say. So stamp duty, for instance, is exactly the same if you buy in a company structure or in your own personal name. So you're going to pay exactly the same amount of stamp duty on the purchase of the property. Now on the resale of the property, that's where it's slightly different. So if you have your property under a company structure and you sell to another company, then they'll have a dramatic reduction in stamp duty. They'll actually just pay the land tax. They won't pay any stamp duty. So if you sell to an individual, they will still pay stamp duty and land tax on their purchase. So if you're looking to sell and you go company to company, there is a significant saving there. So that would be, people may view that as an opportunity when you're looking to sell, to open up the market to company buyers as well. Then looking at, in the past, which the government changed in 2015, was that you could actually deduct your interest of your mortgage payments against your pre-tax profits and lower your tax bill on an annual basis. Now, from a personal perspective, they changed that, and only actually 20% now of your interest you can then deduct against your tax profits. Whereas as a company structure, you can deduct the whole amount of the interest against your profits. So that then does, obviously potentially not a significant saving, but it's going to lower your tax bill on an annual basis. With the company structure, there is obviously an ongoing cost. So you will need to have someone that's going to manage that company on an annual basis, which does add on to the costs of going down that route. And you probably will find that mortgages are going to be a bit more of a, not a struggle, but they are going to be less of a market for, there's going to be less of a market for you from a company perspective. Now, let's say 5 years ago, the market for company mortgages would be very small. And, over the last five years, there certainly has been a lot more banks that have come to the market and brought company mortgages, but making it more available. But there still is less than when you are buying in your personal name. So you could potentially, although yes, your interest could be more deductible, but you could be looking at paying more of an interest than you would do as a personal purchase. And also you may not have the flexibility of certain fixed rates or variable rates that will be there available on a personal perspective. Because ultimately what the banks will look at is how big is that mortgage market from a personal perspective as it would be from a company perspective. There's a huge market from individuals buying properties. So there's a real competition there that banks will be kind of having that kind of price war for individual markets rather than from a company perspective. So that is then, you could be looking at, the cost is going to be greater from a lending perspective. And then I think, when you're looking at other taxes, and again, we won't go into it in too much detail today, but, from a capital gains perspective, when you're looking to offload the property, there are ways that actually when you sell as a company, you'll be selling the shares and you can offload those shares over a period of time through your accountant so that you could potentially lower your capital gains tax liability on the sale of that. Now, as I mentioned, RPA as a business, we don't run that company structure. I'm happy to say today there's a company called Get Ground that we work closely with. There are other businesses out there, but we have a really good experience with them. And we're more than happy to set up a meeting with our investors and ourselves and talk through the benefits of both. And ultimately, I think it's down to the investor's decision at the end of the day, and we'll look at both perspectives as we go through the investment case. Do you guys have anything else to add on that front?
No, I think you pretty much nail on the head there, Mike. Okay. So we've got any questions from the audience?
Yeah, so let me just check here.
Good.
Yeah, we've got 3 or 4 questions here. One question: what investments?
I tell you what, Mike. Why don't you pick out the better? Because I feel like time's probably kicked on people before we got things to do now. What do you think is the best? What do you think is the strongest Most commonly asked question you've seen come through there?
I think it's, well, I mean, look, someone's asked, what projects or investments should I avoid in the UK? I mean, that's quite a broad question. But, I think, what I've seen in, over the last decade of working in investments, international investments, I've seen a lot more projects with, super high yields that are being advertised and marketed, across the internet. And I think, the internet is a fantastic place and a fantastic thing, but actually it can have a detrimental effect. And I think it's when people go on and look at, best or high yields and all these kind of things. And I touched on it earlier about having that view of yield is risk. So the higher the yield you're looking at, the higher the risk you're potentially putting yourself in to not have that balance of a good yield and capital growth on your investment, certainly in the UK. And
I think property, if the old the old saying, if it seems too good, it seems too good to be true, it probably is. I think that isn't ever more personified in property, really. That when we're looking specifically at the UK markets and that side of things, because of how established it is, because of all the sort of constraints that are in place and things like that, it's very difficult to go way off the norm. And when you're way over the norm, it normally means there's something not quite right.
Yeah, I agree. And I think the other thing I would mention is, I've seen the, student accommodation has become more prevalent in the market. As we talked about, the population is growing in the UK. It's a solid legal system, financial system, and education there, as we know, is one of the best in the world. So that demand is there. So the demand for student accommodation is obviously increasing, which we know. Now, there is a market for it, but I think people need to be educated and know what they're getting themselves into. As an example, student accommodation, you can't mortgage student accommodation because of the size of them, and banks just won't lend against them. So you need to be a cash buyer when you're looking at these projects. Now, that's okay if you're a cash buyer, and a lot of these projects will offer, let's say, a guaranteed rental for 3 or 5 years. And the scenario that I use is if you're happy with your 3 or 5 year guaranteed rental and you just want to sell it, and you're happy with buying at a certain price, not necessarily getting an increased yield, and then selling it at the same price or potentially a loss, then fine. Now, if you are looking for capital appreciation as well, then this really probably isn't the investment for you, because in 3 or 5 years' time, when you're looking to sell it, there's going to be another project, a brand new project on the market that's offering a 3 or 5 year guaranteed rental, and you won't be able to do that. So it's going to put you in a position where you're just not going to be able to compete with what's on the market, and potentially going to have to lower your sale price, which will eat into the guaranteed rental that you just had for the 3 or 5 years. So it's not as simple as taking that guarantee for 3 to 5 years and it being a fantastic investment. You really need to look into what it means. And also, ultimately, when you look to sell it, you're going to have to sell to a cash buyer. You're not going to be able to sell to a mortgage buyer. So again, you're closing that net of investors that you're proposing to. And I think they're probably the key things to look out for when looking at investments in the UK. So I think right, Elliot, it's been a good period of time now. I'd like to keep it short, keep it brief, but educational, obviously. So I just want to thank everyone for joining us today, wherever you've joined us from today. And if you want any further questions, please visit our website. With everyone else that has asked questions, we'll get back to you on email and contact you after the webinar to help answer those. If any of you would like to have set up a free consultation with any one of us as a team, please feel free to contact us on the website, and we'll be happy to do so. So again, thanks for joining us, and have a great weekend, and we'll speak to you soon.
Cheers. Thank you very much.